All right. Good evening, everyone. It is 7 p.m. We'll go ahead and get started. My name is Xavier Duran. I am the Arts, Culture, Educational Programming Librarian for the Lisle Library District. A couple things before we begin. This program is being recorded, so in the event that something happens where you get cut off or there's some weird audio issues and maybe you're not able to come back to the room, we will have this recorded and available soon. With that said, all of you are on mute. And if you have your camera on, just wanted to let you know that your camera might be on. I would double check that if you know that you want to have your face shown, or if you're in the middle of eating a very messy dinner, just make sure that your camera is off if you want it off. With that said, I will see any questions that you have. Please go ahead and put them in the chat. Myself or Judy will be able to answer them or convey them or answer them that way. With that said, I have done a lot of talking, so I'll go ahead and turn it over to the delightful Judy.
Xavier, I want to thank you, and I want to thank you all for coming. One of the things, and I love Lyle because, as many of you know, I taught at Benedictine University for many, many years after I taught at George Williams College. And part of the reason I love doing this is because I will probably always be a teacher in my soul. And so, um, even though now my office is in Chicago, we still serve lots and lots of my suburban clients or our suburban clients, just so you know. And I'm not looking for more clients at this moment. But Beth, my office manager, who many of you have talked to, lives in Woodridge, and either she or her husband pick up forms and drop off forms or talk to everybody. And if I'm working with you, I'm working by Zoom or by telephone, however you wish. Let me start by saying, for better or for worse, I've been doing taxes forever, and every year I say to myself, why in H am I still doing taxes? Well, I think this year is going, if it's not your downfall, it might be mine. I'm going to say, as you listen to this, you might or might not be able to absorb it all because a huge amount has happened in the last year. Probably the biggest thing that's happened is there was a huge tax bill called the OBBBRA, or Big Beautiful Tax Bill, that passed in the middle of the summer that we'll be talking about. It's going to change things a lot for 2025. It's going to change things more for 2026, so that you will hear a lot about what's going to happen with your tax return. The second thing that you're going to hear from me, and I am dealing with, and maybe you will or you won't deal with this, but the IRS actually has 30% less employees than they had at this time last year. What that means is that if you try to get through, or even I tried to get through, the probability of getting a person on the line or even staying on hold for half an hour is probably close to zero. You will probably get a machine that says, sorry, we don't have anybody to talk to you now. Try at another time. So the probability of getting any kind of help besides, and you'll hear me talk about online help in a little bit, is really very limited. And so everything is being done by computer or online. It's going to be a very interesting tax season. Before I start, and I only see one chat from somebody that said his camera wasn't on, but I want to see what kinds of questions you might have for me first before I start giving you all the stuff about the new tax laws. Does anybody have any questions that specifically you want me to answer right away? Or as I
Yes, I
go,
do. This is Kathy. Can you hear me?
yes.
Yes, hi. I'll try to show my video here. I'm not sure how to do that. But anyways, I was just wondering how you learned of all the tax changes.
You mean how I learn about them?
Yeah, how did you learn about all the tax changes?
Okay. Well, I'll answer that question right away. One, I get emails almost every day about the tax changes, but one of the things that you need to know, and this is probably pretty important for whether I do them, you do them, or somebody else does them, I carry a credential that's called an enrolled agent. What that means is that many, many years ago, I passed an IRS test on all aspects of taxes. And so I can do anything with the IRS that a CPA and a lawyer can do. That also means that I'm required to take 24 credits of continuing education a year. And over the last 3 years, just to give you an example, I had 88. So that part of my responsibility to me and then also to you is to make sure that I know these laws. And actually, one of the things I love doing with these workshops is explaining it to you because then I know I really know it.
Yeah,
Oh,
I really appreciate you. I've been a client of yours in the past, and I've since done it myself now because I've learned from you. So I do
oh, thank
appreciate
you.
that.
All right. Any other
Uh,
questions before we continue? If you have
Hi,
questions,
Judy. This is Mike Kerner. I don't know if you can hear me.
yep.
Okay, yeah, I had two questions I hope you'll cover. One is when we've had a couple, sadly, a couple people pass away in our family, and so we have widows and widowers. And I wonder if you could cover how the surviving spouse would approach the tax return for that year of death. And then the other
I
thing I was wondering, yeah, and then I don't know if you could also cover the situation of estimated taxes. We've got another situation within the family where people came into some money right at the end of the year, and how would you deal with the estimated taxes? Um, filing them and calculating them. So, those would be my two things I hope you'd cover.
those are good questions, and I'll try and answer them. Mike, I do so that you all know, because I've been doing taxes for way too long, I am doing a lot more work after people die. And I wish I could do a whole workshop on that, which I won't do. I'll explain it a little, but then there's a lot more. If some of you have questions, um, I can answer them. I can't answer specific questions related to your case, but
Oh, of
it's
course.
tricky. Okay, let's start by just telling you what is going on and what isn't in the tax laws. First, in 2017, when it was Trump's first term, they did several things that are still in place. One, they lowered the tax rates. And so they're still at the low rates that they've been since 2017. They inch up for inflation, but they're still at the very low rates. Okay, they're still at the very low rates for what we call qualified dividends from stock and long-term capital gains rates. For certain ones, if your income is low enough, they're at 0, then they're at 15, and maybe they're at 20. Those are still in place. They haven't been made permanent, but they're still in place. So in all the years that I've been doing taxes, these are the lowest rates that I've ever seen. Okay. One thing that happened that's going to be important for many of us is they got rid of, they changed the itemized deductions and the standard deduction. They made the standard deduction double, and they got rid of all of the personal exemptions. There used to be a personal exemption for each one of us. They got rid of those. And so what they've done is they've made the standard deduction, they made it double what it's been double what it was before 2017, and then they upped it a little more. In addition to the standard deduction, they've also got an extra $1,000 per person if you're over 65, and that's still been in there. What's new for 2025, and this is both, there's good news with this, and then also I'll talk about the bad news in it in a minute. There's a new senior deduction for each senior, depending upon your income. The senior deduction is an extra, it's called the senior bonus deduction of $6,000. So if you're married, and your income is low enough, you're going to get right off the top an extra deduction of $12,000. So that sounds wonderful. What is, quote, the bad news? The bad news is that this deduction phases out. So they give it to you on this hand and they take it away on this hand. So where does it start phasing out? It starts phasing out at $75,000 for singles and $150,000 for married. That includes all of your income, okay? Your tax exempt income, all of your Social Security income, which we'll talk about in a little bit. And so again, this is a new deduction, and it might be big or it might not, depending on what your income is. But this is the senior deduction. Now, one of the things that's tricky, there's a new form called the Schedule 1A, where you're going to have to figure out the senior deduction. And most of us do our taxes by computer. But again, this is an easy place where there indeed might be errors. So this is the senior deduction. And as far as I know, given that I said that there were substantially less employees at the IRS, at the moment they're telling us the tax season is supposed to start on January 26th. I have no idea if the forms are going to be final on that date. Okay? I think Terry or somebody else asked how I know. I get emails every day on when the forms are final and when we can e-file, because if things aren't final, then I can't do the work. We'll talk about when you get your documents in a little while. Okay. As I said before, there's a double standard deduction and there are no exemptions. Here is something else that changed, and this is also really big. Okay? I told you the standard deduction, just so you have a sense. It's 31,500 for couples and 15,750 for singles, and then plus the other. So that's a pretty big standard deduction. One of the things that happened in 2017 is they decided, when they were trying to really have people not itemize their deductions, to limit the deduction for real estate taxes and state and local income taxes. That was limited to $10,000. It was called the SALT tax, S-A-L-T. They have now changed that, okay? They changed that to be equal to $40,000, so that if I have, and I don't have very many of them, I have more of them in the city than I do when I lived out in the suburbs. I have a client in Oak Park that has $26,000 in real estate taxes. You and I wouldn't do that, but he has, okay? He was always limited to $10,000 and he didn't itemize, he's going to be able to itemize now. Okay, so again, that's a really big difference. It's $40,000 up from the $10,000. That includes the tax from Illinois that we pay, and it includes our real estate taxes. And so it will depend whether your total itemized deduction is over that 31.5 or not, of whether you itemize or not. But that's a really big difference. And it may allow a lot more clients to itemize in 2025. What I am telling people to do, and we'll talk about medical back in a little more in a while, but a lot more of my clients, because we are older, are looking at medical deductions. And so people have big medical deductions. They have now the state and local income tax and real estate tax. And indeed, they may wind up itemizing for 2025, even if they haven't itemized before. So that is pretty important. Okay. There is a phase out for these SALT taxes that are up to $40,000, but I don't think any of us are going to reach it because it's 500,000. And I have, maybe I could count them on one hand. Okay. So those are really big things. The other thing, and most of us, I think on this Zoom are not young, but there is a per child credit. It used to be $2,000 up to age 17. Now it's $2,200. It's not very big, but that's what it is. It's $2,200. Now, another change that's critical, and I don't like this at all. We used to be able to get a really good energy credit when we did windows, when we did doors, when we did energy efficient furnaces, when we did energy efficient air conditioning. That's gone. It's in for 25, and after that, it's gone. So there will be no energy credits, even if you spend a fortune replacing your air conditioning. Okay, in 25, it's still here for your main house and even for a second house. There was also a credit, an energy credit for things like Teslas and energy efficient cars. That ended in September. So that's not here at all. Okay, not at all. So again, a lot of the kinds of things you're seeing have begun to change. So what's something that really didn't change? Okay, something that really didn't change, and this is, to me, this is one of the biggest tax savings that I can tell you. It's our required minimum distribution. What happens is most of us have IRAs, most of us have 401ks. If we used to work at a company, they may have been rolled over to an IRA or they may have not. Once you hit age 73, you are required to take out and make taxable a certain amount from your IRA. How that is figured is pretty straightforward. You take the value of your IRA or all your IRAs and 401ks at the end of the year. You add them all up. And then the IRS has what's called a life expectancy table. And unfortunately, most of us keep getting older, not younger. And so the amount that we have to take out, and I'll say this absolutely have to take out, is based upon the value of all your IRAs and this life expectancy table. At 73, it starts out at 27.4 years. I don't think I'm going to live that long, but that's how long it is. And that's the, I'm going to say it, that's the minimum you have to take out. Okay? It has to sit in the middle of your tax return and you have to pay tax on it. It is not taxable by the state of Illinois because IRAs and all retirement income, at least for now, are not taxable by the state of Illinois. Now, depending on, some people have one IRA, some people have different ones. They have one from work, they have a couple in the banks, they have one at Fidelity or Vanguard or Edward Jones. It doesn't matter where you take the required minimum distribution out of, as long as you take it. And you have to take it every year, otherwise there's a penalty which they've never enforced. But it's called an RMD. And what happens is, if you look at the stock market recently, all the values of our assets keep going up. So the value of our RMD that we have to take out is more. Okay? Here is a really big way of saving taxes. You can, and this was put in, I think, in 2017, you can give money to charity directly from your IRA so that you don't take the money and then give the money to charity. You tell your IRA trustee to give $1,000 to your church, $1,000 to the DuPage food pantry, $500 to the Boy Scouts. Wherever you decide you really want to give money, you have to make it from the IRA trustee. They send a check or wire transfer it. What happens on your tax return, when you get your forms, the form for your IRA is called a 1099-R, which stands for retirement. That form will have the gross distribution and the net distribution. When I or you do your taxes and you scroll down, there's a little box on that form that says QCD, or Qualified Charitable Distributions. I create a pop-up box, and every one of the charitable distributions go in that pop-up box. They get subtracted from the taxable IRA. So on your 1040, it'll show up over here for the gross. Next to it, it'll say QCD, and the net that's taxable will be the net after you take the QCD out of it, depending on what your tax bracket is. And if you aren't itemizing, that's a great way to do charitable contributions. Lots of people give their money to the church. That way, instead of putting the money in the basket every week, they make a one-time contribution, from your IRA. And that saves a lot of taxes. Okay, so that's this required minimum distribution. I think Mike was asking a little bit about what happens when people die, and this is how they changed the rules in 2017, and they finalized them a couple of years ago. If I have an IRA and I die, and my spouse inherits my IRA, then he can take it out a little bit at a time, just like I've been talking about. But let's say my spouse is gone, which he is, and my kids inherit my IRA. Okay, however much it is. Let's say it's, I don't know, 250,000, and I have two kids, so they each get 125,000. They have to liquidate that IRA within 10 years on a ratable basis. They can't keep it forever. They can't keep it and then take it out at the end of 10 years. You have to take money out of your IRA, if it's an inherited IRA, every single year. So that when somebody dies, and this is, if we get back to one of the important things, it's really important in your IRA to list beneficiaries. Some people don't do that, or some people don't look at who the beneficiaries are. many, many, many years ago when I changed where I had my IRA and I looked at who my beneficiary was, you know who it was? It was my ex-husband. Before I ever met my second husband, I got divorced from him in 1978, and he was still on my IRA. How stupid was that? Thank God I found out. Okay, but lots of people never look at who their beneficiaries are. I had one client, her ex-husband was the beneficiary of her IRA, and she had dementia and she couldn't change anything. And he inherited probably $500,000. So again, you need to look at those. You need to make sure they're accurate. You need to make sure you take the money out. Okay. And unfortunately, when you take it out, it's all taxable. So IRAs are a very tricky thing. And in the year you turn 73 is when you have to start taking them out. So that becomes really, really tricky. And every year, because we get older and our life expectancy is less, we have to take more out of our IRA. And if you looked at the value of your IRA as of the end of 2025, my IRA went up about 15%. What does that mean? It means I have to take more out. Now, that's not bad. Maybe I'll take a trip, or maybe I'll put it in my great-granddaughter's 529 plan. But it's still taxable, okay, from the IRS. Again, it's not taxable in Illinois. Now, if you were a client of mine, we could run some numbers and say, if you gave away this much money, this is how much tax you would save. If you gave away this much money, this is how much tax you would save from your RMD if you can afford to do that. And so, again, it's better to give it away from your IRA if you're not itemizing your deductions. So this is really, really big. Okay. It is also big because Social Security has not changed. And well, it's changed in one way, but this is a really big problem with Social Security. Back when, a long time ago, and I was still doing taxes, no Social Security was taxable. They started making Social Security taxable in 1982 when they wanted to get more money, but they didn't want to raise the tax rates. It was a political game that they were playing. And so they said, depending on what your income was, 50% of your Social Security could be taxable income. In 1992, they also didn't want to raise taxes, and then they made it all the way up to 85%. So if you are single and all of your income plus half of your Social Security is above $32,000, then 50% of your Social Security is taxable. And if it's above $44,000, then 85% of your Social Security is taxable. So I would tell you that of my clients, probably 90% are paying tax on at least 50, if not 85% of your Social Security. Even if your income is low, once you start getting Social Security or you're taking out your IRA, then your income keeps getting higher and higher. And so Social Security is an interesting problem. And I'll talk a little bit more about what happened with Social Security and Medicare in a minute. But something else happened is there anybody in this Zoom that's a teacher? Do you all know somebody that's a teacher or somebody that's a government employee? I'm sure you do. So one of the things that happened in 2025, and this is very big, and you need to tell people and you need to pay attention to this. Before Biden left office, they passed a bill called the Social Security Fairness Act. And here's what it means. If you were a government employee or a teacher or a policeman or a firefighter, and you were getting a government pension, you had what we called a Social Security offset. So you didn't get much, if any, Social Security at all. The new bill, the Social Security Fairness Act, changed that. I won't call it fixed it, I will call it changed it. And so if you were one of those people that I just talked about, you got the very small amount from January to March. In March, many people got a surprise in their bank account of a huge amount of catch-up Social Security back to the beginning of 25. And starting in April, they got a huge amount more of Social Security. So when you or somebody you know gets their Social Security statement, you say, where the heck did that money come from? Okay, all of a sudden you used to get this much, and now you've got this much. Do you know what happens to it? 85% of it almost is taxable. And then you really screwed up on your tax return. It's nice that you had more money. Many of my clients, because I told them, they called and we fixed their estimated taxes based upon the amount of money. Excuse me. But because it showed up in your bank account, and most people don't look at their bank statements or they don't look online every day. I do, but most people don't. And the kids surely don't. All of a sudden they say, oh my God, where did this money come from? I spent it all, and now I have to pay tax on it. So again, when you start looking at it, that money goes right into the middle of your income, usually at 50 or 85%, and it's called the Social Security Fairness Act. Now, I have a question, because usually Social Security is incredibly efficient. How many of you have gotten your Social Security statement yet? It usually comes at the very beginning of January. Has anybody gotten one yet? Some people have. I didn't even get mine. We're going to talk about how to get it if you didn't get it, but usually you get it right away. Okay, so it is an interesting problem. I'll talk to you how you get it if you haven't gotten it yet. But again, nothing is coming very early. So that's a very big thing that's changed, and we're going to see huge numbers of teachers. So far, they haven't changed that in this administration, but that's a huge. I had one client who was a librarian, and I think the Darien Public Schools, and her husband died about 5 years ago. She got $27,000 in back Social Security. And now instead of getting like $400 or $500 a month, she's getting like $2,000. So we're not talking about an insignificant amount of money. Okay, she's pretty savvy. But a lot of people never looked at their bank account and noticed that the money was there. You just spend whatever seems to be in there. And then all of a sudden you wonder, how come there's so much more money? Well, that's why. It's called the Social Security Fairness Act. Okay, and so far that's still going to be there. It hasn't changed at all. Again, because Social Security is retirement income, it's not taxed by Illinois, but it is taxed on the federal side, and it could increase your income substantially. Okay? So then there are just a few things. Okay? In Illinois has really not changed much. Illinois, the federal tax has a graduated income tax, okay? But Illinois' tax is 4.95% across all your income. So that if you're in a lower bracket federally and you get additional income, you might be surprised. A lot of people are now being surprised that they're paying Illinois tax that they never had to pay. And the only thing that Illinois has is a deduction. They have an exemption, and the exemption went up to $2,850 a person. And if you decide you want to give money, which I do to, I have a great grandchild now, but if you want to give money to 529 plans for college, you can put money in, and that's a subtraction. So those are the kinds of things that have really changed so far for this year. Okay. Are there any questions about changes before I go into what might be different otherwise? You're all okay?
I have a
It,
question,
oh,
Judy. This is Janet
Yes.
Hoffman. I'm one of your clients, and I pay estimated taxes because I work and collect my Social Security. And I keep hearing that Trump is, I keep hearing somebody say no more taxes on Social Security.
That's not true. There
On-
is all this tax on Social Security, and it has not changed.
What are they talking about?
That's just rumors, and nothing will ever happen, as far as I know.
Okay,
Not at the moment. There's Social Security is still being taxed at 50 and 85%.
okay. Thank you.
So, and again, if we go back to your question related to what we call estimated taxes, I'm going to talk about how to pay them in a little bit. But I want to tell you what the law is on estimated taxes. When many of us are retired, and so when we were working, our taxes were all withheld from our pay. Okay. And I loved it when I was a young teacher and I didn't have any money and I was divorced with 2 kids and I'd get a refund. It was wonderful. Okay. Now I'm working on my own. The law says that you're supposed to pay 90% of the tax you owe during the calendar year. Most of us now don't just have one job or 2 jobs and maybe a bank account or two. We have all sorts of places that we are getting money from. We have an IRA, we have a pension, we have Social Security, we have investment accounts, we have bank accounts. And so it becomes really tricky to figure out what is this 90%. There is what we call a safe harbor of equal to last year, but the IRS is very good. It's easy for them to figure out that you aren't at 90%. And if you were my client, I just figured the penalty in there. Okay. And then, but otherwise, they send you a bill for a penalty. One of the problems that I'll talk about in a little bit is that a lot of the income that people get comes from investment accounts at the end of the year, and they really get screwed up with this estimated tax. It is a problem. And again, whether it be you or me, when people got this big amount of Social Security, I probably did 15 or 20 people, and we increased their estimated tax. We did. Or we had them take tax out of their Social Security so that at least at tax time, they didn't say, oh my God, why do I owe so much money? Which is going to happen a lot in 2026 because lots of people are going to be surprised. I'm sure you all know a teacher If you go home and tomorrow you ask a teacher, did you get extra Social Security? They'll say, I don't know. Look in your bank account, figure out what you got. Okay. And then they'll say, oh my God, I guess I did. Because they'll be surprised a teacher, a policeman, a fireman, a government worker, any government worker, including our wonderful people in Congress, got the money, got all this extra money. So
So
yes,
I have a question.
yes.
If I take the standard deduction, can I still write off charitable contributions?
Okay. If you take the standard deduction, right now for 2025, the only way that you can take charity is if you do these qualified charitable contributions from your IRA.
Okay.
In 2026, they're going to allow you to take $1,000 of charitable deductions, even if you don't itemize. But that's in 26, not in 25.
Okay.
So that's why I tell everybody to do these what we call QCDs, because the charity otherwise goes into what I call some big black hole.
Right, right. Yeah.
Now, I'm not suggesting people do this, but let me give you a good tax planning strategy if you can afford it. Okay? Let's say you decide that you really want to give, and I'll give you an example for 25. You really want to give big money to someplace. Okay? Maybe a one-time big contribution, whether your church is having a building fund pledge, or you want to give money to your college, or somebody died. I had a client that graduated from McAllister in Minnesota. And he and his wife wanted to underwrite a scholarship for something. I don't remember what it was. Okay. We figured out that given the $40,000, he's the one with this big amount of real estate taxes in Oak Park. And so this was the best year to give this big contribution because then he would be able to itemize and it would be worth it for him. I saved him $12,000 by giving away that much money. Okay. But
Okay,
again,
yeah. Yeah.
part of what we're talking about, whether you do it or I do it, and a lot more of my business is helping people plan how to do this. Okay? Because it just depends. Now, he gave away appreciated stock, he gave away Apple stock. And when you give away stock or a mutual fund, you can get the charitable contribution for the fair market value of what you give away. So it's in some cases it's better to give away stock or a mutual fund than it is cash. It doesn't hurt as much because you're not using it and you're sure as heck aren't selling Apple stock. You bought it here and now it's worth this. So he gave it away to this college. But that's the kind of thing that's tricky. Again, I think the person that was asking about estates and trusts and what happens when people die, there is one of the parts of my business now is a huge amount of helping people decide what to do. I got an email just before this started from a client. I don't know how old he is. He's in his 70s. And he said to me, my broker thinks I ought to roll over my IRA to a Roth. I have $245,000 in my IRA. Do you think I ought to roll it over to a Roth? What do you think I told him in an email? Absolutely not. Do you know how much tax he would have to pay if he rolled over $245,000 and stuck it in the middle of his income? At 75 years old, it'd be crazy. But again, these are the kinds of questions that we're asking and that are important besides just doing the work of preparing the taxes. All right, I'm going to talk about a couple of other things as we go along. It is only the middle of January now. Most of us have absolutely. Oh, I want to say one other thing that's changed, and most of us won't have it. Maybe a couple of people will. They changed the law. Hold on, I got to find this thing. They changed the law, and there's a certain amount of tips and overtime if you're still working that aren't taxable. It's a very complicated computation. Most of my clients don't have that, but if you do, we have a worksheet and they ought to look at it. It will be on their W-2. And again, there'll be 2 worksheets on the 1040 to figure out how much of that is not taxable. But that's just something you need to know. I don't know how many people are going to have it. I don't know how it's going to work. We haven't, again, we don't know what the W-2 is going to look like and how it's going to be figured. I just know that's part of the new law. Okay? So here are some things that might surprise you as you start thinking about your taxes. The first one is this, and this happened last year as well as it's probably going to happen this year. Whether many of us, including many of my older clients, feel very comfortable keeping money in banks. They get CDs here, they get CDs here. If the CD matures, they go running to the next bank. Well, CDs a couple of years ago paid 1% and 2%, and now they're paying 4.5%. They're a little bit down this week, but that's what they're paying. So lots of people had substantially more interest than they ever had before, and they owed taxes. They didn't even realize it because the money isn't in their bank account. It's not in their pocket. They're not used to spending it. But all of a sudden, they get their 1099 from the bank and they say, what in the H happened? I mean, I'll give you a simple example. I have an account from my business and it had, I don't know, this much money in it. And I said, that's really stupid. Why am I keeping money in a checking account? So I took out 50,000 and I put it in a money market account at 4%. You know what 50,000 at 4% per year is? And it's extra $2,000 of interest. It's great to have it, and then all of a sudden it shows up on your tax return. So if somebody has 100 or 200,000 or more that was sitting in something that wasn't earning interest, all of a sudden their interest, which is considered what we call ordinary income on their tax return, gets to be pretty enormous. And that's at the what we call the marginal rate. Again, I had people with a very small income, then they got more interest, and what happened to their Social Security? 85% of it became taxable. So it's like a double whammy. It's like crazy. Okay? The second thing that happened is that there are a lot of people that have savings bonds. We are dealing with a lot of them. A lot of people used to get savings bonds at work. They put aside money every month in a savings bond. They'd bring them into me in a shopping bag, and we'd figure out that they were expiring or they were finished. Okay? When you cash in those savings bonds, immediately 100% of the interest is taxable. Immediately 100% of the interest is taxable. And so again, it's nice to have them, but when you cash them in or when they mature, and then I have a client that died and she had $100,000 worth of savings bonds that she never cashed. There's about $80,000 worth of interest that's going to sit there after she died from these savings bonds that were there for 30 years. Now, again, I want to say to you that U.S. interest, and that's from savings bonds, is not taxable in Illinois, but it is taxable federally. So far, we're talking about 2 things that increase your income, which then affect the taxable Social Security. The third thing is this, and this is really big. And this happened last year, and it's going to happen. It's already happened this year. And again, somebody else asked about the end of the year. I called this an end of the year surprise. Many of us have mutual funds with stock. And these mutual funds are managed by a fund manager. So unless you're selling anything, you have no control over what the fund manager does. Many of the fund managers thought that the market, which was going like this, was going to start doing this at the end of 25. And so they sold stuff in the mutual funds. When they sell stuff in the mutual funds, you get your 1099 from Fidelity, from Vanguard, from Edward Jones, and it says ordinary dividends, qualified dividends from stock, and then what's called long-term capital gains. They aren't things that you sold. These are things that the fund manager sold. So I had somebody that called last week and we did a figure, and she had $31,000 of long-term capital gains from her mutual funds, okay, which is sitting in the middle of her tax return. And so these mutual funds are crazy. And again, you have almost no control over what the fund manager does. Now, there are also, so if you're in Edward Jones or Fidelity or Vanguard or something like that, some other people have, they might be in Morgan Stanley or somebody else, and they have somebody managing their money. If somebody is managing your money, often it's being managed by a computer, and you're going to find that they're buying and selling all the time. And so there may be huge amounts of gains by the fact that they sold and took gains because they thought the stock market was going to go down. So again, you may look at your monthly statements, but when you get your, what we call your 1099 at the end of the year, you say, holy Toledo, where did that come from? And then you look and you see what they sold. So a lot of that, if we go back to tax planning, I work with clients to help them be in tax managed accounts so they don't have these kinds of surprises at the end of the year. And this becomes a major, major problem. Now, one, we've talked about 1099s. There are 1099s from interest. There are 1099s from dividends from stock. There are 1099s from mutual funds. And there are 1099s from brokers. I hope that most of you have a list of what you should be getting and that you're checking them off as they come. Because here are two things that are happening. One, quite a long time ago, the IRS gave the brokers until the middle of February to get the forms to us. So, of course, we never get anything in January. I don't get busy till the middle of February. But the other thing that's happening now, and this is a major problem, we used to get everything in our mailbox. I used to check it off. I'd get my Fidelity. I'd get my what's called CIA CREF from when I taught at Benedictine. Everything would show up in my mailbox. The only mailbox that most of my stuff shows up on is in my email. Because if you really look at your account online, the default is no paper. The total default is no paper. So they send you an email and hopefully you can log in online and download your statement. Okay? I can't begin to tell you how many people that I work with that are missing statements. I say, so where's your statement from such and such? Oh, I don't know. It didn't show up in my mailbox. Well, of course not. And then what do I have to do, or they have to do? They call their broker. Their broker talks to me because they're authorized from them. The broker sends me their 1099s through some sort of secure mailbox. Then Judi Strauss has to download the 1099. I have to print it, and then I have to charge them more because, again, I'm doing more work than before they've got it. Or they send their stuff to me, and then I say, so where is the one from so-and-so last year? Oh, I didn't get that one. I guess I forgot it. I wonder where it is. Well, where it is it isn't in your mailbox. It's online. Many of our older clients can't do that. They don't remember their online access. I have one wonderful client who unfortunately died in 25, and he was hard of hearing. And so I get on the phone with his broker with him, and they try and verify him so that the broker could talk to me, and they'd ask him, what his name was and where he was born, and he'd say, I was born in an orphanage in Germany. And they'd say, Mr. S, you flunked. And so we couldn't get any answer. And I couldn't talk to the broker because he couldn't verify himself. And again, this became a really big problem, but you have to make sure that you have all of your 1099s and hopefully that they're posted online, and then you print. I really recommend that you print them and put them in your tax folder and you don't just look at them online. The other thing that happens now, because the IRS has given the mutual fund companies and the investment people longer. How many of you have gotten a 1099 that says this is the initial 1099 and we might get a revised one in March? Okay, and so then you shouldn't do your return and I shouldn't do your return until later. I got an email this week from somebody. I had no idea who in heaven's name she was. Okay, her mother was a client of mine many, many years ago, and they sold some stock apparently in 2023, and they forgot to put it on their tax return. The IRS sent out a letter 2.5 years later called the CP 2000. They count the cost basis of that stock as zero and send them a bill for the tax and the penalty for not paying and interest. And she said, what do we do? And I said, well, I have to look at it, and I probably have to, if you want me to do it, I probably have to redo your entire tax return with whatever the correct cost basis was, which they don't have. And then we have to file an Illinois one. So if you don't have everything, then it is a major problem. And I tell people to wait so that it's now the middle of January. I used to get busy and people like to have their stuff finished and their refunds coming in February. I will tell you that I probably work 12 and 14 hours in March and April. I probably don't get busy until the second or third week in February because people don't have their stuff. And so you should have a complete list of where you have your stuff and make sure that you've got it all before you ever start. It is a major problem.
Judy, I had a question at this point on the 1099s. So you're saying that if
Talk louder so I can hear you.
Okay, on the 1099s, you're saying if we don't get a paper statement in the mail, that the issuer will send an email about that?
Either they'll send an email or you should log in online and make sure that it's there in your account.
Oh, okay. Thank you.
And you need to tell everybody that way because, again, the default of everything, including my bank statements and all my bills, says We don't want any paper statements. You don't really need a paper bank statement. You don't really need a paper bill. Uh, okay? And maybe I'm old fashioned, maybe I'm old, okay? But I like to get paper bills. And you know what? I look at them. Okay? I'll give you a really good example. And this is funny. I'm required to keep old tax returns for 7 years. Okay, because I'm an enrolled agent. When I sold my house after my husband died in Downers Grove, we rented a storage space on Lamont Road and 75th Street. Okay? And so I had huge numbers of bankers' boxes in this storage space. They set up some kind of an account and they charged my credit card every month. That was fine. It started out as $270 a month. I figured that was okay. Last month, it went up to $490. They never sent me an email. They never sent me anything in paper. And I finally decided, the heck with that. We're going to bring them downtown and then we're going to shred the old ones. But again, I never got a statement. I never got anything. It showed up on my credit card every month. Okay? And that's what they want you to do. They don't be bothered sending out anything in paper at all anymore. And I don't remember who asked the question, but this is a very important part of that question. You shouldn't just download the first 2 pages of the 1099. You should download every single page because it might have the amount of US interest that you can take off in Illinois. It might have your foreign tax credit on it. It definitely has all your sales on it. So you really need to look at it. And one of the advantages of tax season is to look at what's going on with your investments. Okay? And so people just tend to download the first page, and that's not good enough. And you need to keep that stuff in. I have a white folder that looks like, I don't know where it is. It's not, oh, they look like this. And every single person for every single year has one with all of their original documents in it and their tax return. And so if we go back, and probably this is a good place to say this. So let's assume that you forgot something.
Judi,
Okay?
Judi,
Yes?
I just want to add that there are some times where you do not have any income on a mutual fund that you may know. So that may be the reason why someone who didn't choose an email option for the receipt of their 1099s may not get one. So if they look at their year-end statement, it may be that there were no capital gains, there was no interest. That has happened to me. I just want to mention that that could be an issue,
The
So,
thing
but
is,
it's always very good, as you pointed out, to always check every investment you have to make sure you know if you should have gotten any kind of 1099 from.
thank you. And again, many of them don't. And for a long time, the ones that were what we call NASDAQ really didn't have any 1099s because they didn't produce any dividends. But a lot of the mutual funds in these AI and NASDAQ stocks are now having capital gains that you wouldn't think would happen. And so,
Absolutely,
yes,
yeah, yeah.
and this is totally, it's not that you've sold something, it's that the fund manager has sold them. And again, most of us, it's a pain in the butt to go online all the time and check this stuff. Okay, and hopefully you're going to get an email. Again, I need to say about emails, first of all, we all get so many emails that I'm spending half of my day deleting junk.
Yes.
Okay? And so you have to be very careful about what's real and what's junk. The IRS, Social Security, Illinois, They don't send out emails at all, at least not right now. Okay? They don't send out emails at all. But again, let's assume, and somebody said, are we going to get an email that we've got something online? Maybe yes, maybe no. But again, that's why it's important for you to keep a list of what you had last year, and if you changed what you have this year, and if you're missing something, God, call somebody up and find out why. Okay? Because it's a problem. I had somebody that called up and they said, oh, you didn't get a 1099-R because you forgot to take out your required minimum distribution. Oh my God. Okay? And you have 65 days after the end of the year to take it out. So he was able to take it out without a penalty. But that's why he didn't get a 1099-R, because he forgot to take it out. So all of this becomes, I won't call it stressful. I'll just call it, more complicated than by far it used to be. Okay? And so I'm hoping that you get that. Now, I want to say one other thing about all this. There has been ongoing a lot of what we call identity theft. Okay? I'm sure most of us know at least one person that has had their credit card stolen or their bank account stolen or gotten into something. And so the IRS has a system now to try and protect them and us. It's called identity protection pins. So I am required now to what we call electronically file the returns. Many, many years ago, I used to send them, we all sent them all in paper. We got paper checks and refunds. None of that is what happens now. So we e-file the returns and I get an acknowledgement that they've been accepted. If I get a reject, which happens every once in a while, but not very often, and you might get one too, it might say that somebody else has filed with your social security number. Well, it's easy for somebody to get your social security number. Half the time when you're buying something online or they're trying to verify your insurance or something, they ask for your social security number. So it's really easy for people to get a hold of it. The way the IRS has set up a protection is called an identity protection pin, IP pin. Okay? If you have identity theft at any year with the IRS, you are required to have an identity protection pin. You have to get it online with this crazy system that I'm not going to talk about, but it's a pain in the butt called ID
Judy,
Me.
can I ask a question? This
Sure.
this identity pin you're talking about, is it different than, that I think it's like a 5-digit number that you have a filing pin for? Is that different?
That's the same thing.
Oh, really? Okay.
It's called an IP pin.
Okay,
And
because
if you get one, you have to get a new one every year.
okay, thank you.
You have to get a new one every year. You have to go online and get one for you and one for your spouse. If you have a spouse and they have it. You can also elect in to get one if you want, even if you haven't had identity theft. Okay? Just because you want to protect yourself, it's another layer of protection at the IRS. We have a list of all the people that have identity protection pins, and we send them a reminder that they have to get one every single year, because if they show up at my office or they bring their stuff and they don't have one, then that's another layer of work that somebody has to do. Okay, and I will tell you, I wouldn't tell you that it's hard to do it. I will tell you it's not easy to do it. Several years ago, when I had a temporary office in Downers Grove the first year after I sold my house, there was like a screaming fit between a husband and wife. He got an identity protection pin and she didn't know that he got one, and he didn't know how to do the one for the next year. And so we were standing and doing it online. I thought they were going to have a divorce in my office. Okay, it was really cute. But again, these identity protection pins, I think, are important, but you have to do them online. And there's a whole system. I'm not going to go through it right now to tell you how to do it. It's not hard, but it's not easy. And there are a lot of people, especially older people, that have trouble doing that. Okay? So that's number one. Number two, okay, and this is something else that's pretty important, is that a lot of people are thinking about selling their house. That, thank God, has not changed. There's still an exclusion of profit of $250,000 if you're single and $500,000 of profit if you're married. Here's how the selling of a house works. You take the selling price from the closing statement. You subtract all the expenses of the sale. That is called the net selling price. Then you take what you paid for it, add all your capital improvements. Capital improvements are all the things that increase the house in value: roofs, landscaping, air conditioning, okay, windows, things that, kitchens, bathrooms, remodeling, surely not carpet. Okay, I had a brick driveway that increased my house in value. That is called the basis of the house. The difference between the net selling price and the basis is the profit. Just to give you an example, I have a client whose husband died in 2025. Okay, I was the second marriage, she owned the house. Okay, he didn't own the house, she owned it. There's only $250,000 of profit. When did she own the house? Since 1972. Is there profit? There is profit. I figured it out, like $75,000 in profit, because she only gets $250,000 of exclusion of gain. And that sits in the middle of her tax return as long-term capital gains. Okay, there is no exclusion, and I want to say this loud and clear. If you sell a second house, if you sell a piece of land in Colorado, okay, no matter where you are, if you have a loss on a house, you can't take a loss. But if you have a gain, you have to pay tax on the gain. So if you sold land in Colorado, or you had a second house in Wisconsin, we have to pay tax on that federally. And guess what state we have to pay tax on the house sale in? Wisconsin. And then we have to figure out and get a credit for Illinois. So this house sale, we're seeing many more people selling their houses, okay, because they're moving to nursing homes, or they're moving to Florida, or they're moving to Tennessee, or wherever they're moving. But again, that's a problem. Okay? Now, one other thing I want to say, and then we'll talk more about online, and I could talk forever. We've got a lot more. I want to talk about one thing that a lot of people aren't aware of. It's called IRMA. Does anybody know what IRMA is? IRMA is, so when you pay your Medicare and you can look at your Social Security statement, there's a base rate for Medicare and a base rate for your drug plan. Okay, it actually went up a lot. It went up way more than Social Security. It went up 9.6% last year. Okay, I think I'll look at where the number is. And so if your income is higher, based, and there's all different levels, you pay more for Medicare. You pay more for your drug plan. And it's not just a little, it's a lot. The Medicare this year went up from $184 to $202 per person. It's a lot. It's a big increase. Just to give you an example, because I'm still working, I'm paying double that much. I'm single now. My husband died. I'm paying double that for Medicare. Okay? And so there's nothing we can do. It's a year by year figuring. If you remember about a half an hour ago, I talked about the person that asked me, should he roll over his money to a Roth? You know what would happen to his Medicare? It would go through the roof. It would absolutely go through the roof. So it isn't worth looking at that, and you need to figure out what this is going to happen with your Medicare. Again, if you give money away to charity from your IRA, that lowers your income, and it's based upon your gross income, not your net income after deductions. So I want to talk about two other things. We have about 15 minutes, and maybe Xavier will let me talk a little longer. I want to talk about online, and then I'll talk a little bit about the estate stuff that somebody asked me a question about. I want to say this much. I talked about online statements. The IRS doesn't want any paper. They don't want any paper tax returns. They don't want any paper checks from you. They want everybody to pay every single thing online. When I do your tax return, if you're getting a refund, they want your routing number and your account number, and they'll put the money back into your checking account. If you owe money, they want your bank name, your routing number, and your account number, and the date they want to debit it out of by April 15th. If you get an extension, it's not an extension to pay, it's only an extension to file. So they want everybody to pay online. They want everybody to pay their quarterly estimated taxes online. And we now have a complete set of instructions. And my office manager goes to people's houses, or we do it by Zoom like this, so that we're sure that they do it. But it's really important to make sure that you keep track of what date you're paying it and how much you've paid. Because if you don't pay it on time, and you don't pay and you don't put in your tax return correctly what you paid, either you're going to get a bill for late paying, or you're going to get a letter and say, oh, guess what? You said that you gave us this much, but this is what you really gave us, and so you owe us more money. The same person that I just talked about with the charity contribution, we found out that he didn't pay. His wife forgot to pay their third quarter estimate, so they made two payments in the fourth quarter. Is that going to be a problem? Of course it is. But she just forgot. Okay? Now that I said that, one of the things that's real is I can, which you're not supposed to, I can go back and look at Illinois online and see what you paid. You're not supposed to, and I suppose I'm really not supposed to, but I can check it. I cannot check what you've paid the federal government. The only way, besides you keeping track of it, to check, which is what the IRS wants now, is for every single person to have an online IRS account. And you have to do it through a system that's called ID.me, which is not so easy to use. You have to do a thing with a picture and your driver's license or your state ID, and we help people do it. But again, it's really important to pay everything online and make sure that you know exactly what you paid. Because often, if you get an IRS letter and then you send Judi an email and you say, what an H is this? And I say, well, this is what you told me you paid. but this is what you really paid. And so you owe the IRS the difference in the money. It's not that I made a mistake. You gave me the wrong information. And so we give people a worksheet and ask them to fill out what they paid and the date they paid it. And if you pay it online, you can print off your confirmation so that you know what you've paid. And that becomes really important. I don't have any idea how my older people are going to be able to do this, but this is what's really critical. Okay? So that online stuff is, and I will say this, even though most of us on this Zoom are older, I will tell you, even the kids, we may not be as tech savvy, but they're not as careful. So even though they know how to do it, they're missing as many things as we are because they forget what they have. And somebody said to me, "Oh, I forgot that I set up this Robinhood account and I traded Bitcoin." I said, "Well, that's nice. You didn't tell me about it." "Of course not." Okay? Some stupid little Robinhood account. Okay? And so the IRS does get every single 1099 that you either get in paper or online. And that is a very simple way not to audit you, but to check what's on your tax return with what they got. And then about 2 years later, when you think you're home free, you get a letter. Okay. And then I look at the letter and I say, well, that's where the problem is. And then they get angry because then they have to pay me to fix it. And I say, well, it's not, this is what you gave me. And so we're really careful on the front end. My office manager, who many of you know, her name is Beth Austin. We actually make sure that everybody has everything before I start doing your tax return. Because if I have to start it, and then I have to go back and download something from a broker, or you give me new information, or you get a corrected one, or we're missing something, then what happens is your bill increases, and then you get mad at me. And I say, well, I've spent, another 2 hours more than I spent last year, so that's why your bill is bigger, but I'm trying to prevent getting letters later on. Okay, the last thing, and I don't remember who had a question. Let me kind of explain. And this is going to be a very simple, quick, and dirty explanation of a very complicated situation. When somebody dies, okay, let's assume they're married, okay, to take an example. Several things happen. First of all, the legal document that determines what happens of what I do and what happens with the person's assets and the money is either a will or a trust. If you don't have a trust, then you have a will, and that has to be probated. And probate is a public thing in court, and you have to hire a lawyer. If you have a trust, you're paying for a lawyer to write the trust over here. And then even though you have to file the will, you don't need a lawyer. You need a tax person, but you don't need a lawyer. So in the trust itself defines who gets the money and how it's distributed. That's true for your assets that aren't retirement assets. As I mentioned before, every single one of your retirement assets should have a beneficiary or more than one listed, or what we call a successor beneficiary. So if I die, my kids get the money, and if my kids aren't alive, then my grandkids get the money because they're the successor beneficiaries. So I have two daughters, and if one of them dies, one of them is 60, or she's going to be 61, then her two kids, my grandkids, will get the money. And so again, you need to look at those. Most people don't ever look at them. Okay, and that's really important. Okay. The second thing that has to happen is that if there's a trust, and usually the trust say something like, we're going to set up a trust for the surviving spouse. It's called an irrevocable trust, and all of the income from that irrevocable trust goes to the surviving spouse. And then after the surviving spouse dies, then the kids get the money. So we're taking care of the surviving spouse with the money until the second spouse dies. And so I work with lawyers all the time. The trust then, so there in the year of the death, there has to be a final 1040 for income from the surviving spouse for the whole year and from the spouse that died from the beginning of the year until the date of death. So what happens after the date of death? The new trust, the when you're alive, the tax return is processed under your Social Security number. After you die, if there's an irrevocable trust, it's a new entity. It's set up under what's called an employer identification number, which either I or the lawyer gets. And the assets go into a new account with what's called a stepped up basis. The stocks get a stepped up basis. They stay in that new account. I then, as a tax person, have to do a second tax return. It is called a 1041 for the trust. And if the trust says that the surviving spouse says the income, then the interest and dividends should be distributed at least quarterly to the surviving spouse. Because of tax laws, if there are sales or long-term capital gains, they are not allowed to be distributed. They stay as taxed in the trust at the very highest level. If you don't distribute the money, the tax rates start at 37% at $14,000. I'm going to say it again, at $14,000. So that the tax rates on the individual side are low. I had somebody where there was an annuity, and the beneficiary of the annuity was the trust. And I kept sending them letters and said, distribute the money, distribute the money, distribute the money. And he said, no, they don't want to pay tax on it on their individual accounts. That wound up paying tax, not this much, but this much at the trust level because they didn't distribute the money. So again, when somebody dies, it depends whether there is an estate and there is no trust document, or whether there's a trust document and then we have to do other tax returns. I will tell you, because I've been doing taxes way longer than I ever want to admit, that I made a list of how many people that I'm doing trust for now, and it's at least on one side all the way down the page of a yellow sheet of paper. Probably 10 years ago, I might have done one or two. Okay, I am not now doing probably 20 or 30. And that's because I've got clients where one spouse dies and we have to do these things for the other one. Okay, I'm also doing what's called special needs trusts. Now, the final thing I want to tell you, and this, most of us are not there, but some of us are. Okay, there is something called a death tax. Okay, and that's different than an income tax. Income tax is based upon what you earn every single year. The death tax is based upon the value of all of your assets when you die. Now, right now, for the IRS and for the federal government, that's 12 or 13 million. Most of us are not there. I have practically nobody that's there. Okay? But Illinois is a problem. And this sounds like a lot of money, but if you add up what you have or you know somebody, it's not as much money as you think. It's 4 million. Okay. And some people have houses that are worth 700,000 or 800,000. Some people have IRAs that are worth that money. I have a client that has huge amounts of Apple stock and they have $11 million. And it came from the Apple stock that started here and they just bought it, 20 years ago and now it's worth a fortune. And so all of a sudden, if somebody dies and they have that much money, I have to fill out a federal, what's called 706, and then I have to fill it out an Illinois 700. It's off the 706, and I have to pay tax to Illinois. I have a client that died several years ago, and she was single, and she gave away enough money to charity to get her below 4 million. She did. She gave away enough money to charity. I had to file the forms, but she didn't have to pay any tax. She said, I'd rather give it to charity. She was single, and her brother had lots and lots of money. And so his kids inherited the rest of her money. Okay. And she gave away 1.8 million, which sounds like a lot, but that's what she did to get below 4 million. So one of the things as we wrap up, and it's past 8:30, that I really want to say is whether you do your own or whether you have somebody do it, the most important thing is one, to make sure you have all your documents, to make sure that you're not just putting the numbers in the forms, but that you understand why it happened, and how you might save money for this year and then also for next year. For every single client that walks in my office or I do their tax return, we look at their required minimum distribution. We look at whether they should give money to charity. We do tax planning. We help them figure out their estimated tax so they don't come in here and say, oh my God, why do I owe $10,000? I don't know where I'm going to get it from. Okay. So at least they know where they're coming from. And if there's nothing else that you're going to take away from this, I suggest you find a friend or a relative that's a teacher and a government employee and ask them whether they got any extra Social Security in 2025, because I think they're going to be surprised. If you have some questions that are not specific, because I can't answer specific questions, but if you have general ones, you can call the office and either Beth and I will answer and call you back. The phone number is 630-964-4018, or you can email. If it's something that I can answer very simply, I will be happy to do that. If it's more complicated and, I might have to do some computations, I might tell you and you can choose whether hire me or not. But as I said, because I feel incredibly loyal to the libraries, many of you have either been my supporters or come to workshops in person and now on Zoom. I am incredibly grateful for the libraries and for all of you for many, many, many years. And so far, this lady that's been doing it forever isn't planning to pack it in this month. I want to thank you
Well,
very much. And I wish
thank you,
you
Judi.
a healthy and good year.
Well, thank you very much, I have to say. And thank goodness you do this every year, Judi. Thank you very much.
You're welcome. And as I said, I honestly will tell you, I wish I could tell you that this year is going to be simple. I'm not only scared for me, but I'm really scared for all of you because I think it's going to be a challenge. And the online stuff is a really big challenge for everybody.
Well, Happy New Year to you, and thank you for doing this, Judy.
You're welcome, everybody. If you need me, I still am around and live and sitting in my office, as you can see. Bye.
Bye
Thank
bye.
you. Appreciate it.
Thank you.